Okay, so we will go to the Ind AS section. We will start with the asset based standards. This is Ind AS 16 on property, plant and equipment. I would put this into the tier 1 important category standard. Tier 1 would be like the A category chapters, tier 2 will be the B category, and tier 3 would be the C categories. So when I go to applicability of Ind AS, I would put that into the tier 3. It is less important, whereas Ind AS 16 property, plant and equipment is under tier 1. Now PP. This kind of standard forms a base for a lot of other standards like intangibles, investment properties, etc. And hence we would want to do this properly. So let us say PP. Have we done a separate standard like this in our CA interval? Yes, this went under the heading of AS10. So when we look at AS10, this is property, plant and equipment. Now what all gets covered under a PP? Like if I am a coaching institute, the cars that I have, the building that I have, the projectors, cameras, equipments that I have, do I think I'm holding this for the purpose of sale, or do you think I'm holding this for the purpose of use? So we are holding this for the purpose of use in the ordinary course of business. So when I look at PP, there are three main characteristics. First, it has to be tangible. Tangible meaning it has to have physical form, like a patent, copyright, trademark. They don't have physical form, and hence they cannot go under the PP criteria. They should have physical form. Second, it should be held for the purpose of use. Use can be any kind of use. It can be for production, for administration, for selling and distribution, for employee welfare. It can be for any kind of use, but it is for use and not for the purpose of sale in the ordinary course of business. And third, it should have a life of more than 12 months. So these are the three core PP criteria. The word use over here, in my opinion, is the most important thing. Some people mistake this as only those assets which are held for the purpose of production, which can generate output. No, in my factory I might have machines which can help me in making goods. They are definitely PP. But apart from that, I can even have, let us say, a painting on my reception area, and that is for office decor. That is also held for the purpose of use. Or I can have a pollution control equipment that may not necessarily directly increase output. A student wrongly believes that only if it increases output is it said to be held for use. No, use can be any use. It can be office decor. It can be, let us say, if you see videos like Google has offices where they have bean bags and PlayStations and Xbox, and these are for employee welfare. Then we see our office, unfortunately. So over here, when we look at these assets, they are held for the purpose of use. Use can be any use: employee welfare, administrative, selling and distribution, pollution control, and it can be a PP. It should not be held for the purpose of sale in the ordinary course of business, in which case it becomes an inventory. Are we clear with this? Okay, so over here, and the life should be more than 12 months. If it is less than 12 months, like a consumable, for example, we don't put this into the PP criteria because a PP will usually be depreciated over more than 12 months. So these are the three main conditions: tangible items held for use and having a life of more than 12 months. Second, what is scope exclusion? What is not included in PP? First, you will have non-current assets held for sale. Like I might buy a bench for my classroom, but sooner or later, some or the other day, I will want to dispose that bench. In which case, this is a non-current asset like a bench, which is no longer held for the purpose of use, but held for the purpose of sale. Now, I can't show it as inventory because Ind AS 2 looks at inventory which is sold in the ordinary course of business. I don't sell benches in the ordinary course of business, and hence a bench is not inventory for me. However, it is not even a PP for me because I'm no longer holding it for the purpose of use. I'm probably intending to sell it, for which we have a new Ind AS called as Ind AS 105. So non-current assets which are held for the purpose of sale will be covered under Ind AS 105 and hence will not be covered under Ind AS 16. Second, there are certain exploratory and evaluatory assets linked to mining operations, mineral rights, etc. Like for example, when I am someone like an ONGC who is, or Reliance, British Petroleum, who is looking for oil, I spend a substantial sum of money trying to explore and evaluate whether it is worth digging over here or not. And hence, that is called as an exploratory and evaluatory asset, for which there is a separate standard called as Ind AS 106. Ind AS 106 is not in your syllabus. Ind AS 105 is there in your syllabus. 106 is not there because of the very technical nature of these exploratory and evaluatory mining linked operations. And hence, we need to know that these exploratory and evaluatory assets linked to mining operations will be covered under 106. They are not a part of Ind AS 16. 106 though is not a part of your syllabus. And the next exclusion is, in my opinion, the most important from your exam perspective. Biological assets. What are biological assets? Assets which have life. Like, for example, livestock. So if you look at a company like Amul, which has, let us say, cattle is livestock, it has life. So biological assets, should they be covered under Ind AS 16? Amul owns the cows and they use the cow for the purpose of milk, and hence I can say cow is similar to PP. However, the cow has life, and because it is a biological asset, some special features are there unique to the biological assets, like reproduction, for example, is a special feature of a biological asset. Now, considering these special features, there's a separate accounting standard called as Ind AS 41, which covers biological assets which are for agricultural purposes. So if you're holding a biological asset for an agricultural purpose, generally it will go under Ind AS 41. This is on agriculture. However, there's an exception to this, which is on bearer plants. What do you mean by bearer plants? Bearer plants are okay, just a second. Bearer plants are nothing but plants which bear agricultural produce but are not agricultural produce themselves. That is what I call as a bearer plant. Now, for bearer plant, it can be someone like a coconut tree, someone like a mango tree, apple tree, etc., which bears these coconuts, bears these apples, bears these mangoes, and hence a bearer plant bears agricultural produce and is not agricultural produce itself. On the other hand, someone like a bamboo tree or someone like a timber tree, they themselves are the produce. Ultimately, I will cut them down and the tree itself is the produce. So when I look at a bearer plant, the bearer plant bears agricultural produce and is not produce itself, whereas other than bearer plants, well, they maybe produce themselves. Bearer plants, remember, will be covered under Ind AS 16. Other than bearer plants will be covered under Ind AS 41. So when I look at this point, which is important, biological assets for agricultural operations except for bearer plants will be excluded. Why? Because bearer plants are a part of Ind AS 16. Why they are excluded? Because they will be covered under Ind AS 41. Achha, I have given a summary over here. Biological assets for agriculture, these are living assets, can be living plants, can be living animals. If they are living animals, they will be covered under Ind AS 41. All living animals will be covered under Ind AS 41. Basically, all living animals which are used for agricultural purpose, like cows used by Amul, for example, will be covered under Ind AS 41. Or sheep which are held for the purpose of rearing and getting the wool will be covered under Ind AS 41. Or if you are running a poultry farm and you have, let us say, hens who are giving, let us say, eggs, they are also covered under Ind AS 41. We will study Ind AS 41 separately. But remembering that all living animals, that is livestock, what you used to call, will be covered under Ind AS 41 only. There is nothing called as a bearer animal. As per Ind AS, there will be something called as a bearer plant. A bearer plant is a plant that bears produce, like a mango tree bears mangoes, a coconut tree bears the coconuts and is not produce itself, like a bamboo tree is a produce itself. So, if it is a bearer plant, it will be covered under Ind AS 16. If it is other than bearer plant, then will go under Ind AS 41. Now, how will we figure out whether it is a bearer plant or not? It has to bear produce and it has to have a life of more than 12 months. Sir, why? Because if it is a bearer plant, it will come under PP, and for PP, you should have a life of more than 12 months. Now, there may be so many crops, like if you are a farmer, you have a crop like a wheat grain. Over here, the plant of wheat grains bears the grains and hence technically can be a bearer plant. However, if you see how agriculture works, there are many seasons like the Kharif season, Rabi season in agriculture. Farmers, what they do is they will grow the wheat grains, then they will harvest them, put a new crop, grow them, harvest them, put a new crop. These plants will not have a life of more than 12 months. For you to be a bearer plant and covered under Ind AS 16, you should have a life of more than 12 months. Like a coconut tree, mango tree will have a life of more than 12 months. In fact, if you go to Tata Tea, Tata Consumer, you will find that tea gardens which are then Kerala, Assam, etc. You will see people plucking the tea leaves, but they don't uproot the tree itself, and hence those tea gardens, those tea plants are bearer plants because they bear the leaves, which is the produce, and the tree itself is not the produce. Again, we are not doing a biology or a zoology class over here, and hence you don't need to have a very detailed knowledge in terms of trees and plants. What you can generally remember is fruit plantations or cash crops like uh, tea, coffee, rubber, etc. are usually bearer plants or fruit plantation. Like for example, you will have uh, a coconut tree or a grape vine. All of these will be usually grapevine, meaning vine vine. So these are grape trees are called as grapevines, the creepers, or the apple trees or orchards. They will usually be bearer plants because they bear agriculture produce. Other trees can be taken as other than bearer plants. Now the question might give you a very unique tree because one of the RTPs had given you a Pinus radiata tree. Now Pinus radiata tree, even the best of the zoologists might not be aware. We will not be aware. In such a case, institute will tell you what the tree will be used for. Like in that question, institute had told you we have 100 Pinus radiata trees which will ultimately be used for the purpose of furniture as well as building materials. What do you guys think? Is it a bearer plant or is it other than bearer plant? Is it bearer plant or other than bearer plant? Other than, that is right. So when I look at other than bearer plant, because it is not bearing any produce, the tree itself is the produce. So when I look at bearer plants, if I have to explain it again, what are bearer plants? These are living plants which bear some produce. Like coconut tree bears the coconuts. The tree itself is not the produce. The bamboo tree itself is the produce and is not agriculture produce itself. A bamboo tree itself is the produce. Second, they are expected to bear produce for more than 12 months. So their life is beyond 12 months. Like a wheat grain plantation will bear wheat for less than 12 months and hence it will be chopped off after that. So it cannot be a bearer plant because if it is a bearer plant covered under Index 16, it has to have a life of more than 12 months. So if it has a life of less than 12 months, then we will not cover it under Index 16, we will take it under Index 41 only. Now, someone can always argue that sooner or later, some or the other every tree will be chopped. Like a mango tree might have a life of 50 years. Over 50 years, it will keep on giving me mangoes, but after 50 years, I will chop it. However, say a fixed asset also is ultimately sold, salvage value. That does not make a fixed asset inventory. So, merely because a mango tree will ultimately be chopped does not mean it is not a bearer plant. That proceeds that I will get on ultimately chopping the tree is salvage value. It is incidental in nature. I am growing the tree mainly for the purpose of mangoes that it bears and hence the mango tree is a bearer plant. Are we clear with this? Are we clear with bearer or you want more explanation? There is a remote likelihood that the plant itself will be sold except for incidental scrap sales like a salvage value. A mango tree is held for mangoes. However, ultimately the tree will be cut down and sold. Classification is based on the primary intention, that is for mangoes. Is it clear? Great. From an exam perspective, you will not necessarily be asked to write a short note on bearer plants. However, you will be given a case in a bigger exam scenario and you will have to apply your knowledge and figure out whether Index 16 will apply or Index 41 will apply. And that is your art. Once you figure out what 16 will apply, you will generally know what is to be done in case of PP. If you figure out whether 41 is to be applied, you will ultimately know what is to be done for agriculture. Okay. So, a reference point, unless given otherwise, fruit trees, tea, coffee, rubber plantations are bearer plants. Are we clear with this? Okay, so this is just the general introduction of PP, not really important from an exam perspective. What is going to come under Index 16 are four main areas. First, initial recognition. Second, subsequent expenditure. Third, subsequent valuation in the balance sheet. And last, depreciation. Like at what value, if I were to buy a car, at what value should I record the car? Initial recognition. After I buy the car, I do subsequent expenditure like maintenance, repairs, put a CNG engine inside that. What will I do with that? Subsequent expenditure. At every balance sheet date, how do I value the car? Do I value it at cost or NRV, whichever is lower? Do I do costless depreciation? How do I value the car? Do I record it at fair value? Subsequent valuation. And fourth and last, depreciation. How will you depreciate an asset? So these are the four main areas which you will cover under Index 16. We'll start with the first and probably one of the most important areas, that is initial recognition. Initial recognition of a PP. Tell me, when I buy a car, at what value should I record it? Option 1, cost. Option 2, fair value. At what value should I record an asset when I buy it? Quickly answer. Cost, that is right. Cost is the amount that you pay. Now the fair market value of the car may be 10 lakhs. You are a very hard negotiator. You negotiate and you get it for 9 lakh 50. In which case the cost for you is 9 lakh 50. Let the fair value be anything. The amount that you pay for the car is the cost of your car, and hence what will be there as a part of your cost? Well, the purchase price, what you pay for the car. For example, 10 lakh rupees, 9 lakh 50,000 rupees is a part of the cost of the asset. So purchase price. Now comes the problem. Now there would be taxes like GST, stamp duty, etc. What do you guys think? If you're buying something for 100 rupees and you're paying an 18 rupee tax, let us say GST, for you, the appropriate cost should be what? 100 or should it be 118, or it depends? Well, it depends. It depends. Whenever in doubt in accounts, always say it depends. Okay, so it depends. It depends on what? Well, whether the GST of 18 is creditable or non-creditable. If I can claim a credit of that 18, then it is not really a cost. Like if I am paying 118, of which 18 is creditable. What do you mean by creditable? When you will do IDT, you will see that ultimately when you have to pay GST, instead of paying the GST, you can use this as a credit. So in such a case, you will pass the entry asset account debit 100, input GST or GST receivable account debit 18 to bank 118. Ultimately, you will sell some goods, generate some output GST, so bank account debit to sales to GST payable. Let us say GST payable is 27. In which case, how much is the actual GST you will pay? GST payable account debit 27 to input GST 18 to bank only 9. So basically that 18 that you are paying now is going to help you in reducing the GST payment in the future, and as a result your net cost is 100 rupees only. So if GST is creditable, it is not a part of your cost. Cost will be 100 rupees only. However, a lot of times custom duty is not creditable. Like if I were to import a car, 100 rupees ka car hai, I will pay, let us say, another 100 or 150 rupees as customs duty. So I don't get any credit for it. In which case my cost will include the purchase price of the car plus the non-refundable, non-creditable taxes. Or I buy land, building. If I buy land or building, for example, there is stamp duty. I don't get any credit for the stamp duty, and hence I will capitalize it. Now, remembering the fact that we are solving an FR paper and not an IDT paper, so institute does not expect you to be a pro. Generally, they will tell you whether the taxes are creditable or non-creditable. If they don't tell you anything, the general presumption in almost every sum that we have seen is it is assumed that GST is creditable, whereas other taxes are not creditable. Now, one can always argue once you study the IDT paper that some part of GST may be, some part may not be. We are not solving an IDT paper. We are solving an FR paper, and hence if the question tells you, you solve it accordingly. If it remains silent, you will have to make an assumption, and the general assumption that the institute makes is GST is assumed to be creditable, whereas other taxes, maybe stamp duty, custom duty, local taxes and cess levies are assumed to be non-creditable. In fact, there have been sums where they have told you out of GST only 50% credit can be claimed, no credit can be claimed, then you will solve it accordingly. Are we clear with this? Yes? Okay. So over here, when you look at an initial recognition, as you rightly said, initial recognition of an asset should be at cost. For a purchased asset, you will say purchase price, for example, 100 rupees. Plus non-creditable taxes, let's say non-creditable import duty, let us say 20 rupees should be a part of the cost. Now, what do you think about discounts? Should discounts be deducted? Well, if it is trade discount, it should be deducted. If it is cash discount, it is usually taken to the P&L as per generally accepted practices. Now, how do you figure out whether it is a trade discount or a cash discount? Well, cash discount is a discount which is linked to early payment, whereas trade discount is every discount other than a cash discount is treated as a trade discount. So generally, if you buy more quantity, you get a discount, trade discount. You are a hard negotiate, you negotiate and get a lower price, trade discount. You have a good relationship with the supplier, you get a discount, trade discount. But if it is linked to early payment, it is cash discount. So generally accepted practices tell you that if there is a trade discount, so if they are giving you, let us say, a 10 rupees trade discount, that will be subtracted. Are we clear with this? Okay. And apart from that, if there are any other directly attributable expenses which are incurred to get the asset in the ready to use condition, they can be capitalized. Like for example, if I were to buy an AC, I need to install the AC. So installation expenses directly attributable to getting the AC in the ready to use condition. Or I need to have a power supply connection so that the AC can operate. Again, in this case, it is directly attributable to get the AC in the ready to use condition. All of these will be capitalized. Or if I were to import a machine from Germany, the freight inward, the transit insurance, loading and unloading charges, all of these are directly attributable to get the asset in the location and condition as desired by the management, and hence these are called as directly attributable expenses. They will be very well capitalized. There is no exhaustive list for a directly attributable expense. You will have to look at the facts of the case and figure out whether the expense is directly attributable or not. But in general, if there are expenses which are as a part of your purchase transaction to get your asset in the location and condition that you desire, that will be capitalized. So these are directly attributable expenses. Institute has given you a certain list of some items which are not directly attributable. But other than that, directly attributable expenses should ideally be capitalized. So if there are any directly attributable expenses, they will be capitalized. So let us say there is a 30 rupees installation fee. You will capitalize it. And this will be taken usually as a cost of the asset which you are purchasing. Now sometimes you might not purchase an asset, sometimes you might construct your own asset, in which case instead of the purchase price that you are paying to the supplier, you will have direct material cost, direct labor cost, certain direct expenses, overheads. Again, overheads can be production, administration, selling and distribution. You will have overheads, can be fixed or variable. What all will be going as a part of your cost of the asset? Material cost, definitely if you are constructing an office, the brick, cement, etc. will definitely be a part of cost. The laborers who are working to construct will definitely be a part of cost. In fact, if you have some equipment like bulldozers, etc., which you have taken on rent and you are paying the rental cost, or if you own and you are incurring certain depreciation, will also very well be a part of the cost of the asset. Power cost, fuel cost, which are variable expenses which are directly linked to construction, will very well be a part of the cost. However, if there are usually administrative expenses or selling and distribution expenses, usually unless given otherwise, they are not directly linked to constructing the asset, and hence administration expenses or selling and distribution expenses unless otherwise given will not be added to the cost of the asset. So when we look at an asset being constructed, direct material, direct labor, direct expenses, variable production overheads, fixed production overheads, to the extent they can be allocated to our asset, can be taken as a part of the cost of the asset. Apart from that, if there are any other directly attributable expenses, you will take that. If there is any non-refundable, non-creditable taxes, you will take that. Here, there is application of some other standards as well. Like there will be a separate standard called as Ind AS 23, which is on borrowing cost. If you are constructing an asset which takes a substantial period of time, have you heard about this before? If you are constructing an asset which is taking a substantial period of time, then any loan taken for that asset, if you are incurring any borrowing costs, you will capitalize the borrowing cost during the period of construction. You will study this separately in Ind AS 23. However, in the CA Inter, you might have studied a standard called as AS 16 on borrowing cost, where if your asset was something called as a qualifying asset, that is, it takes a substantial period of time to be ready for its intended use, then the borrowing cost which is attributable to the qualifying asset will be capitalized. Are we clear with this? So over here, you will add the borrowing cost if it is a qualifying asset. Sir, if nothing is given, well, you assume it is not a qualifying asset. How will we know, sir, if it is a qualifying asset? We'll study this in Ind AS 23, but typically 12 months is a threshold. If your asset takes more than 12 months, it is treated to be a qualifying asset. If your asset is taking less than 12 months, usually it is not a qualifying asset. However, 12 months is not a legal limit. If your management believes that, like a technology company, for them even 6 months is a substantial period of time. So if the management believes that if any project takes more than 6 months, it is still a qualifying asset. Like if your project takes 12 months, if your project takes 9 months, and the question has told you that the board believes that any project beyond 6 months is a qualifying project, and you are taking 9 months, what do you guys think? Is it a qualifying asset? Yes, it is a qualifying asset, because a qualifying asset would be an asset which is taking a substantial period of time. Generally, substantial period is defined to be a period greater than 12 months, unless the question tells you other way around. If the question tells you that the substantial period by the management is only a 6-month period, then anything beyond 6 months is a qualifying asset. Are we clear with this? What if we take a loan to purchase the asset? Then we will study this in detail. I'm not discussing that right now in Ind AS 23. But if you were to buy a house, you were to buy an under construction house and you take a loan, under construction house, and that under construction house is going to take 3 years. You guys tell me, is it a qualifying asset? Is it a loan for a qualifying asset? Yes. However, if you buy a ready to move house where there's an occupancy certificate, you can immediately move in the next day. You don't have money, you take a loan. Is that house a qualifying asset? No, it is not a qualifying asset. Interest is paid on the house, but it will go to the P&L account. The house is ready for use. In the under construction house, it will take 3 years for the house to be ready for use. You are not constructing it, the builder is constructing it, but you are buying a flat in the under construction property. It is still a qualifying asset. Are we clear with this? Yes, okay. Can you explain what is trade discount? Trade discount, basically there's no definition. Trade discount is defined as a discount which is other than cash discount. So over here, when you look at other than cash discount, that is treated as a trade discount. So when we look at a discount which is other than cash discount, we will treat this as a trade discount. Are we clear with this? Yes, okay. Yes, audio doubts you can ask at the end of the session. At the end of the session, I will put the audio on and you can ask the doubts. In that meantime, if you want, you can just put it on the chat box and you can note that down. At the end of the session, we can take up the audio queries as well. Okay, so this is the borrowing cost which is attributable to the qualifying asset. Now, there is one particular thing where students usually make a mistake for production overheads, and I want you to understand that. So let us say, for example, you are constructing a building, your own head office you are constructing. For that, you are constructing a building and you have incurred a material cost of 100 rupees. Will that be a part of cost? Well, of course. Apart from that, you have certain labor which is working, 50 rupees you have paid to them. Will that be a part of cost? Well, yes. Apart from that, you have certain cranes, which is construction equipment, which you might have seen in construction buildings. You don't own the cranes. So for those cranes, you have taken on rent and you are paying a rental cost of 30 rupees. Think and tell me, these cranes are exclusively used during the year for the purpose of this building construction. Will this rent paid for the crane be attributable to the cost of the building? Yes. So over here, this will be a fixed cost. However, this will be a cost which is directly linked to production and hence it will be added to the cost. And hence your total cost will be, for example, 180. On the other hand, okay, can the management decide more than 12 months as qualifying? Yes, the management can decide that. If nothing is given from an exam perspective, you will take 12 months only. Okay. Now, let us say you have not taken the cranes on rent, you basically own those cranes. If you were to own those cranes, what will you do? You will own those cranes. Let us say these cranes are shown as PP and this is 300 and the life of these cranes is 10 years. In which case, in the current year, the cranes are ready for use, so there will be a depreciation and hence 300 minus 30, that is equal to cranes will appear at 270. Your entry will be depreciation account debit 30 to cranes 30. Usually depreciation is a nominal account, it is taken to the P&L account. However, in this case, these cranes are used for the purpose of construction of a building. What do you guys think? Should the depreciation on these cranes go to the P&L account or should it be capitalized along with the building? Cranes is the nominal account typically, depreciation is a nominal account. It typically goes to the P&L. However, this is used for the purpose of asset. What do you guys think? Yeah, if I had taken an asset on crane on rent, I would have paid 30 rupees on that and hence that will go to my asset cost, construction of building. Here I own the cranes, in which case I don't pay any rent to anyone. However, the depreciation on the crane is attributable to the construction of the building. Now a lot of students say, sir, but we are not paying depreciation. Dekho, we are not doing capital budgeting or AFM, we are doing FR, and in FR you don't look at cost as cash or non-cash cost. Cost, whether it is cash in nature or non-cash in nature, is at the end of the day cost. Depreciation can very well be a non-cash. Depreciation can very well be a non-cash item. Still, is it a cost? Yes. Is it directly attributable for construction of the building? Well, yes. And hence, you will say building under construction account debit, or this can also be called as capital work in progress, to depreciation. You will capitalize it along with the building, and hence even over here, either the rent on the crane or the depreciation attributable to the crane will be capitalized. This is a very common mistake. A student usually, the moment they see depreciation on assets used for the purpose of construction, they say no, depreciation is non-cash, because we do a lot of AFM, and in AFM we try to find cash flows. We are not doing AFM, beta, we are doing FR. And in FR, when they said cost, did they use the word cash cost? No, they use the word cost, and cost includes expenses which are directly attributable to construction. These expenses can be cash in nature, they can very well be non-cash in nature. Are we clear with this? Yes, there will be a proportionate capitalization for the cranes used for the asset. I am assuming for the entire year the crane was used for this building only. It is possible that half of the year it was used for this building, half of the year it was used for somewhere else, in which case I will do proportionate. However, in this case, we are assuming the entire crane for the entire year was used for the purpose of one single building construction only. Are we clear with this? So, one needs to remember over here that when I look at production overheads, this can also include depreciation. This can also include depreciation on other assets used in the construction of our given asset. This will also include depreciation on other assets used in construction of our given asset. Are we clear with this? Is everyone clear? Okay. Now there is something called as this site restoration. We will this also is connected to some other standard called as Ind AS 37, but we will do that at length today itself. It's a little complicated, but before that, let us get clarity at least up to this stage. What all should be a part of the cost of the asset? Let us get some clarity on this part. So we said purchase price plus non-creditable or non-refundable taxes minus trade discount plus directly attributable expenses. Now, what are directly attributable expenses? Well, these are expenses directly attributable to bringing the asset to the location and condition as desired by the management. Basically, which is capable of operating in a manner intended by the management. That is what you call as directly attributable expenses. It can be installation expense, it can be loading, unloading charges, it can be site preparation expenses, it can be freight inward. So many items can be directly attributable. Now, the standard gives you a list of around 4 or 5 items, and this is given by Ind AS 16 bare standard, where they have clarified that these items will not be treated as directly attributable expenses. Now, one could have earlier argued that this is directly attributable, this and that. Now they have kind of put out in black and white that come what may, we will not treat these items as directly attributable. What are those items? First, inauguration expenses. We believe that inauguration expenses have no direct connection with getting the asset in the ready to use condition. You construct, let us say, a particular building, and you, let us say, call Rajnikant to probably do the inauguration. Now he will charge a bomb from you. Now, does that mean your construction becomes more costly? The answer is no. It becomes more costly if the cement, bricks, etc. become more costly. It is not if someone inaugurates. Okay, that is one example. Another example is, we are of a very religious bent. We say that we will call a Pandit, do some Bhumi Pujan and then start construction. So we will say no, if the Pandit does not come and does not do Bhumi Pujan, construction cannot start. So we have done an inauguration ceremony to start construction. Ind AS says any kind of inauguration expenses, whether a Pandit does inauguration or Rajnikant does inauguration or Deepika Padukone does inauguration, we say inauguration expenses are not directly attributable to construction of the asset, and hence they will go to the P&L account only. Point number 1. Following items will not be considered as directly attributable. First is inauguration expenses. Are we clear with this? Second, any expenses or losses after the asset is ready for use. Sometimes it might happen that the asset is ready for use, it is being used and there are losses, we decide to capitalize the losses, or there are expenses, we decide to capitalize. The standard says no, initial recognition will be only those expenses or losses till the time the asset is ready for use. Once it is operating, after that if there are any expenses, we will not capitalize. For example, earlier when Reliance Jio came in, they had this entire optical fiber network, telecom tower network, which was ready for use. They gave you everything free of cost and they were suffering losses. The idea was that these losses, people will take those SIM cards and they will start using it, and hence it will give me future economic benefits. But the telecom tower network was ready for use. So any losses that I incur after that will go to the P&L account. I might say that these losses will help me get a bigger base and hence will give me future economic benefits. Well, Ind AS 16 says initial recognition should be at the cost, which is to get the asset in the ready to use condition. Now, subsequently, if you incur further expenses or losses, whether they give you future economic benefit or not, that is subsequent in nature. When we talk about the initial recognition, only those expenses which are incurred till the time the asset is ready for use will be capitalized. Now the telecom tower network is ready for use. After that, you give the connections free of cost. That does not increase the cost of your telecom tower network. No, ready to use and put to use are not the same. Ready to use is different, put to use is different. Everything that we see over here is for ready to use. Let us say your asset becomes ready to use, but you have not used it for the next 3 months. Why? For whatever reasons. Let's say कोई अच्छा मुहूर्त नहीं है, or let us say you fall ill and you are unable to use it. The asset is ready for use. You use it or not is secondary, and hence put to use is not relevant anywhere. Ready to use is what is going to be relevant. Second, losses or expenses incurred after the asset is in the ready to use condition. They will never be capitalized. Third is cost of employee training. Let us say you buy a bunch of laptops. You want to digitize your entire process. Now your employees don't know how to use computers. You go to NIIT and you get a computer training done from them. Does that increase the cost of the laptops? No sir, the laptops are ready for use. Your employees don't know how to use it, that does not increase the cost of your laptops. Or you buy a bunch of cars, you try to train the drivers for driving. Well, the cars are ready for use, your drivers don't know how to use it, that does not increase the cost of the car. So over here, there was a lot of controversy over here, no employee training is done, that should increase the cost. Ind AS has made it very clear that the cost of training employees to operate an asset or operate in an environment cannot be capitalized into the cost of the asset. So cost of staff training or operating in a new environment with a new set of customers, they cannot be treated as directly attributable. This is the third point. And fourth is relocation. Now again, remember, relocation means the asset is already in the location and condition as desired by the management. Like for example, I buy an AC, I install the AC in my studio. Now I think this AC is very lucky for me. So wherever I go, I remove this AC and I take the AC. I do an entire Bharat Darshan with the AC. Does that mean every time I relocate the AC, I will keep on capitalizing the installation cost? The answer is no. The asset was originally in the location and condition as desired by the management. And hence, if there is any further cost to relocate the asset, as per Ind AS 16, it cannot be a part of the initial recognition of the cost of the asset. Later, if such a relocation increases the life or the efficiency, then in subsequent expenditure we can decide whether to capitalize. Usually relocation does not increase the life or efficiency, but if it does, then in subsequent expenditure we can decide. But in initial cost, we cannot say that we keep on capitalizing the installation cost of the AC. Are we clear with this? So over here, relocation or retraining expenses cannot be added to the cost. And last, may admin and general overheads or selling and distribution overheads will not be added. So these are the items which the standard says are not treated as directly attributable. So here there is no ambiguity. Which are those items? Inauguration expenses, losses or expenses after the asset is ready for use, cost of staff training, relocation retraining expenses, or admin, selling or general overhead expenses. They will not be treated as directly attributable and hence cannot be added to the cost of the asset. Are we clear with this? Are yes or no? Yes? Okay, just a second, this is special case. It's not adjustment in case of OC and NC, it is just a special case. Okay, so over here we have a very specific case over here. We have studied about relocations once more. See, relocation means the asset is already in the location and condition as desired by the management. After that, you can remove the asset and take it somewhere else. Further, you again remove the asset and take it somewhere else. That does not make your AC more and more costly, right? The asset is already in the location and condition as desired, and hence relocation expenses should not be capitalized. Are we clear with this? Okay. Now comes the question of directly attributable income, or let's say incomes during the period of construction. If there are incomes during the period of construction, sir, how can there be incomes during the period of construction? Multiple ways. For example, you took a redevelopment project. There was a building already there. You demolished the building so that you can construct a new building. What do you guys think? Will the demolition cost be capitalized? Think and tell me. Will the demolition cost be capitalized? Yes. It will be capitalized. It is directly attributable, because if you don't demolish, you will not be able to construct your building. Now, that demolition gives you certain debris. You can sell those debris. So, over here, the demolition cost is 50 crores, and on demolition, you will get some debris which you can sell for 10 crores. What do you think? Will you take those 10 crores in the P&L account, or you will show your net demolition cost as 50 minus 10, that is equal to 40? That is right. You will show it as net, because it is directly attributable to a cost of construction. Or a much more common thing, when you want to make a particular asset, do you do a lot of testing before the asset is ready for use? Yes. So what do you guys think? The pre-production testing, will that be a part of the cost of the asset? Testing pre-production, you are doing some testing cost to see whether the asset is capable of being used or not. Should that be capitalized? Yes. Now what happens is, during testing, you get some people to test the asset. Like your products have certain samples, you sell those samples. So let us say your testing cost, you manufacture certain samples from your product to see whether it is, and that is costing you 50, and you sell those samples. Sale of those samples, you will get 10 rupees on selling those samples. What do you guys think? Will I take this 10 rupees into the P&L, or will I show my net testing cost as 40? That is right, I will show net testing cost as 40. Why? Because both of these examples, the incomes that I am getting are directly attributable to a cost of construction. On the other hand, let us say you are constructing a building, your building is half complete. Now a director like Rohit Shetty comes and he sees, for example, that this is an under construction property. You see, most of these Bollywood or all of these movies, villains are usually in under construction buildings. So they say that I want to shoot some of my scenes in this property, and I will pay you a rent of 10 rupees. We are very happy that something is being shot. We give them and we earn 10 rupees of rent. What do you guys think? This 10 rupees, is it directly attributable to a particular cost of construction? No. So where should it go? P&L account. That is right. On the other, so if I earn 10 rupees over here, I will take this to the P&L account. Or let us say I am constructing building and there is some vacant plot of land lying. I am constructing at one side, there is some land which is lying. I give it on rent for car parking for nearby people. I am earning some income. What do you guys think? Is that directly attributable to any particular cost of construction? No. And hence this will be taken to the P&L. So long story short, incomes during construction. Incomes during construction. If there is any income earned during construction, then we will see if it is directly attributable to a cost of construction. If yes, I will reduce it and only the net construction cost will be taken. On the other hand, if it is not directly attributable to a cost of construction, it will be directly taken to the P&L account. So over here, if I go to see income from the asset should be taken to P&L in case they are not directly attributable to the cost incurred, like car park. However, in case incomes are directly attributable to construction, they should be deducted from the cost, like samples from pre-production testing. Now there is a special case over here that we want to discuss, and this is where institute has given clarification, and hence you will have to solve it the way institute does. This is not ICI, this is there in India itself. Let us say you sell the samples, selling samples generates 60 rupees, rare cases. In rare cases it generates 60 rupees. In which case a question arises कि भाई देखो 50 minus 50 तो करना ही है. what do I do with the excess 10? There were two choices. I could have taken the excess 10 to the P&L account, or I could have taken the excess 10 further from the cost of the asset. What Ind AS 16 says is that net 10 would still be reduced from the cost of the asset. I will not take it to the P&L. I'll again repeat, this is given by Ind AS and hence you will have to follow it. A lot of people were earlier saying that 50 is a production testing cost, but samples that I'm generating on testing, I can sell it at 60 rupees. So ideally, 50 minus 50 I will do, 10 rupees I will take to the P&L. Institute says no. This 10 rupees will also help me in further reducing the cost of the asset. It is like saying that in CA Inter you had certain joint products and byproducts. What did you do? If there was any NRV on the byproduct, you used to reduce it from the joint cost. That same analogy is applied over here. And if there is 50 minus 60, that is a net negative 10. That net negative 10 will be reduced from the construction cost. So maybe I've incurred another 500 rupees net construction cost, and then 500 minus 10, net 490 will be the cost. Now sometimes a student, ये तो theoretical level पे होता है, practical नहीं होगा ऐसा. Student might say, sir, what if I sell the samples and I get more than 500 rupees? Rarest of the rare case. If that happens, rarest of the rare, that your assets value itself becomes nil. After considering everything, beyond that asset cannot be shown at negative. So यहाँ पे अगर मेरा total construction cost was only 5 rupees, I cannot show 5 minus 10 as a negative 5 and asset at negative 5. In such a case, my asset will be shown at 0 and 5 rupees will further go to P&L, but वो exam में नहीं आएगा. What you will maximum get is your overall construction cost of the asset was 500. Over and above that, you did testing of 50 rupees pre-production, sold samples at 60 rupees, in which case net 10 would reduce the overall cost of the asset and hence 490 will be the cost. Is everyone absolutely clear with this special case? Okay. In case the sale proceeds exceed the testing cost, then the excess of the net sale proceeds of these items over the cost of testing should not be recognized in the P&L but be deducted from the cost of the PP. Are we clear with this? So this is a special case for incomes. Now there's provision for site restoration. We'll probably do that a little later. First, we'll try to understand basics in terms of directly attributable expenses, etc. Now, sometimes there might be abnormal losses or normal losses. Have you heard about normal and abnormal losses? Well, yes. What happens to normal loss? As per generally accepted cost accounting principles, what do you do with normal loss? Well, normal loss is a loss which was normally expected in the course of production and hence normal loss is capitalized. However, abnormal loss is taken to the profit and loss account. Now, if nothing is given, we will assume every loss is abnormal. Why? Because if it is normal, the question has to tell me that the management expects a 5% normal loss. If it is not given and there is a loss, it will go to the P&L account only. Abnormal losses should be taken to the profit and loss. So over here, when you look at abnormal loss or wastage, abnormal loss should be expensed to the P&L, whereas normal loss should be capitalized. Unless given, losses or wastages are assumed to be abnormal. If nothing is specified, assume the loss to be abnormal. Are we clear with this? Okay. Now we go to a fairly important theory discussion. Over here, this is Ind AS 16 and a separate standard called as Ind AS 37. Ind AS 37 is a standard on provisions and contingencies. This is one of the most important things of this standard. So now you will have undivided attention. Multiple standards get tested over here. Please pay attention. First of all, we'll try to figure out what do you mean by site restoration, decommissioning or dismantling. These are various names. Like, for example, I'm setting up a nuclear power plant. Now, nuclear power plant, when I set up, let us say there is a construction cost. There's a construction cost. If I set up in site A, there's a construction cost of 90 rupees. If I set up in site B, there's a construction cost of 100 rupees. Now, site A is very close to a populated area, whereas site B is a fairly remote area in the middle of a desert. There is no life for miles and miles. Site A is very close to a city. So, what do you guys think? Between site A and B, whatever is the construction cost, which of the two is the cheaper? A or B? Which of the two is cheaper? Very difficult question. Which of the two appears to be cheaper? Well, A. यार B कहाँ से बोल रहे हैं? B is costing you 100 rupees, A is costing you 90 rupees to construct, and hence A appears to be cheaper. Okay. Now what happens is, because site A is located close to a city, the government has said that there is an obligation to restore the site. So there is a site restoration obligation. Site restoration obligation. What does this mean? This is called as a, in short, SRO. What does it mean? That let us say this project, either ways, whether it is A or B, has a life of 10 years. Now, after 10 years, you can't just abandon the site and move away. You will have to dismantle the site, decommission it, and restore it to the location and condition it was before you set up the plant. Because nuclear power is radioactive, I will not allow you to just abandon the site if you don't want to use it. You will have to dismantle it, decommission it, and restore the site to the condition it was when you actually took it. That was a normal plot of land. Now there is a restoration obligation with A, but there is no site restoration obligation on B. Because B is in a remote area, we say that even if it's in the middle of a Sahara desert, even if you don't dismantle it, then it does not matter, no one is going to reach over there, so it is fine. The law has not required you, there is no legal obligation to dismantle. Now you guys think and tell me, is the construction cost to be incurred right now? Well, yes, but do I have to dismantle right now? Do I have to dismantle right now? No, I'll have to dismantle later. So the general common sense process is, if I have to dismantle it later, I'll have to spend money later, and hence I will incur costs later only. Okay. However, when you go to AS 29 in your old standards, provisions and contingencies, or Ind-AS 37 on provisions and contingencies, they say a provision should be created. When should a provision be created? Sir, provision should be created the moment there is an obligation to dismantle. What do you mean by an obligation? Obligation means there is no realistic alternative but to dismantle. You don't have to dismantle immediately, mind you. However, the moment you construct the factory, do I have any alternative but to ultimately dismantle? No, I will have to dismantle, and hence you will have to create a provision. ये students को नहीं समझ में आता. A lot of times students think that, sir, I am going to incur this cost later, I will record it later. It is like saying that when you take a loan, do I have to pay the loan immediately? No, I have to pay the loan in the future. I have to pay the loan in the future, but the moment you take the loan, you are under an obligation to repay. Not immediately, but you are under an obligation to repay, and hence loan is shown as a liability. Or more relatable, if there is a warranty. In C-Enter, if you have done some warranty, if I am Dell, if I sell some laptops, do I usually create a provision for warranty? I give, let us say, a 3-year warranty, but usually in your C-Enter, when you sold the laptops, were you creating a provision for warranty? Well, yes, but then the repair cost was going to be incurred in the future. However, the moment you sell it, you are under an obligation to repair, which means even if someone comes on the very next day, you are under an obligation to repair. Or over here, you constructed site A, now you say, मेरे को nuclear power नहीं बनाना है, and hence you decide that I don't want to make nuclear power, then you will have to dismantle it. The moment you construct, the event that gives birth to the site restoration obligation is the construction of the plant, and hence the obligation to restore, though the payment you will do in the future, the obligation arises. It is like saying income tax. For example, forget advance tax provisions. Income tax, if you earn income during the year, maybe they say self-assessment tax may be paid till the time you file the return. But the event that gives birth to the income tax is earning of income. The moment you earn the income, you create a provision for income tax. So when you study AS 29 or Ind-AS 37, you will be taught that the provision should be created the moment an obligation arises. Obligation means there is no realistic alternative but to kind of dismantle. What is the event that gives birth to the dismantling obligation? So it is the construction of the factory, and hence as per Ind-AS 37, conceptually I will have to create a site restoration provision. So are we clear with this? I will have to create a site restoration provision. So there will be two: provision for site restoration. This provision, remember, is created as per Ind AS 37. You are yet to study that. Now, okay, I try to find an estimate for the site estimated SRO. I believe I will spend 50 rupees. But when will I spend? I believe the dismantling will happen after 10 years. So I believe I will spend 50 rupees after 10 years. So this is my site restoration obligation that I will have 50 rupees, for example, after 10 years. What do you guys think? Can I create, there's a discounting factor also given to you based on various factors. Let's say discounting factor is 10%. Will I create a provision for 50 rupees? Yes or no? The answer is no. Why? Is 50 to be paid after 10 years equal to 50 to be paid today? No. And as a result, we will say, okay, I am passing an entry today because the event that gives birth to the dismantling obligation is the construction of the factory. The moment I construct the factory, I am under an obligation to dismantle. And hence the event that gives birth to the dismantling provision is the construction of the factory. So I will have to create a provision today. But the question is, you will have to create a provision at what amount? Sir, I will have to create a provision at the present value of 50 rupees, not at 50 rupees. Okay. So I'll take 50 into the present value factor at the rate of 10% for 10 years. So I will say 1 divided by 1.1, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. This is 0.3855 and 15 to 0.3855 comes to around 19.28. I will create a provision at 19.28 rupees. Why? Because if someone says pay 50 rupees after 10 years or pay 19.28 today, I'm indifferent. I'm not indifferent between paying 50 after 10 years and 50 today. No, time value of money will play a role. And hence, as per Ind AS 37, you will be told to create. Ind AS 37 requires you that whenever the payment is beyond 12 months, you will have to take the present valuation, and hence you will have to take the present value 19.28. Are we clear with this? Perfect. So you will create a provision. Now the problem is, what will you debit? Double entry, you will have to debit something. Sir, what will I debit? Two options. Can I debit the profit and loss account? Treat it as an expense. Or if I debit the profit and loss, what is the problem? Okay, 19.28 will go to the P&L. And if I open my balance sheet, I will say site A, which is at 90, site B, which is 100. Site B, there is no site restoration obligation. Site A, there was a site restoration obligation. So when I look at this working, I would say, okay, site A will be at 90 and site B will be 100. Let us say, as a company, you decided to set up a project in site B. Now, your shareholders will tell you that you have no sense. You have put up a project in a remote area, spend 100, look at your competitor who is smart, who has put up a project near a city and the project is costing only 90. What do you guys think? Is that correct? Is the true cost of site A only 90 rupees? No. Site A costed 90, which I paid today. However, the moment I constructed it, I am under an obligation to dismantle. I will incur it later, which is 50 rupees. So can I say 90 plus 50 is equal to 140? No. 90 is incurred today. 50 is going to be incurred after 10 years. 50 after 10 years is equivalent to 19.28 today. And hence, I would say that, well, you know what? The true cost of the asset is not just the construction cost, but also, this is where Ind AS 16 comes in. Ind AS 16 says that your cost of the asset includes obviously the material, labor, overhead cost, but it also includes the present value of the site restoration obligation. So if there is a site restoration obligation at present value basis, you will include it into the cost of the asset. And hence, if I now go to see, well, asset A, you must have passed the entry. For A, you can pass a combined entry as well. Asset account debit, let us say 90, to bank, let us say 90. For side B, you must have passed the entry. Asset account debit 100, to bank, let us say 100. B, there is no further entry, but A, there is a further entry. So asset for site A will cost you 90 plus 19.28, that is 109.28, whereas site B will cost you 100. So now I can justify to my shareholders that I put it in a remote area because it is relatively cheaper. Sir, you spend 100 rupees. Yeah, 100 today, you don't have to do any dismantling. and hence no further cost. However, here you spend 90 today, but you'll have to dismantle, which will cost you 50 rupees. Can that estimate of 50 change? Well, yes. How we will account for it, we'll see that probably in tomorrow's class. But for the timing, we just want to understand that what if the estimate of 50 continues to remain the same, in which case 109.28 will be the cost of the asset. So your asset will be at 109.28. If the life is 10 years, then depreciation over 10 years would be 109.28 divided by 10, and hence that is 10.928 per annum. And hence after 10 years, your asset which will get depreciated after 10 years, you guys tell me what will be the ledger balance of your asset after 10 years. Please answer in the chat box here. What do you think will be the value of the asset after recording 10 years of depreciation? Sir, nil. 109.28 was the value. Now, after 10 years of depreciation, it will be a big zero. However, what about provision? So, this is entirely as per Ind AS 16. Now, the provision we are yet to study as per Ind AS 37. Your provision to start with at year 0 was 19.28. Now, you have three options. You do nothing, in which case at the end of year 10, your provision becomes 19.28 only, option 1. Option 2, you depreciate the provision so that it comes down to a zero value after 10 years. Or option 3, you do some adjustment whereby it goes up to 50 rupees. What do you think is the appropriate adjustment? Let us assume there is no other change in estimate. Yes, 50. Why? Because my initial estimate was I am going to spend 50 rupees. So if I don't do anything for 10 years, this will be 19.28. Suddenly I'll end up spending 50 rupees. So my entry would be provision account debit 19.28. After 10 years, I will say to bank. Yeah, to bank, so I'll have to spend 50 rupees. And hence there will be a huge 30.62 or 72. I think 30.72 shares, 30.72 cost in the 10th year. But what do you guys think? Is this burden arising because of the 10th year, or is it arising because you're getting a time over 10 years? What do you guys think? That difference between 19.28 today and close to 50 rupees, is it because of the 10th year, or is it over 10 years? That is right, over 10 years, and as a result, it is wrong to put the entire burden on the 10th year. So this keeping it at 19.28 is wrong. Taking it to 0 is also wrong, because if I know that I have to spend 50, there's no point taking it to 0. In fact, I'll have to take it to 50. Now here what happens is the opposite of depreciation. In depreciation, you take the asset down to the 0 or salvage value. Here, the process of taking 19.28 to 50 is called as unwinding. Earlier, a thing's worth 50 was bound and tied up and made 19.28. I'm slowly unwinding it and taking it up to 50. Now, what is this called? Like asset going from 109.28 to 0, that process is called as depreciation. Your provision going from 19.28 to 50, that process is called as unwinding of discount. This is called as unwinding of discount. So, what will you do? You will say year 1, 2, 3, 4. You don't need to do it for all the years, but just to get a conceptual understanding, opening provision was 19.28. As we have decided that this has to somehow proceed on to 50. How will it proceed on to 50? Well, we will say that every year it is wrong to keep it at 19.28. It is wrong to take it to 0. So you will have to increase the provision or decrease the provision. Tell me. Increase the provision. So basically entry will be from years 1 to year 10. Provision will be credited or debited? Sir, provision will be credited. By what amount we will see that, but provision will be credited. So something will be debited. Acha, can PP be debited over here? The question is, what will you debit? Can PP be debited? The answer is no. Asset cannot be debited. The general answer is, sir, asset should be debited. Dekho, out of 50 after 10 years was equal to 19.28 today. So if I had to, if the government said that I don't trust you whether you dismantle or not, you deposit money today. Will I deposit the entire 50 rupees today? No, I will deposit 19.28 with the government today, and I will say that this 19.28 will grow at the rate of 10% each year and will ultimately become 50. So if the government said that you have to deposit, जैसे आपने escrow account सुना, Have you heard about something like an escrow account? So what happens over here is the government might tell you that you have to put an X amount, let us say, in a deposit, which has to grow, and out of which you have to pay the 50 rupees of dismantling. I don't need to deposit the 50 today. For the dismantling cost, I need to deposit only 19.28, which will slowly become 50 rupees. And hence, the out of the 50 that you are spending, 19.28 is the true cost in today's terms. The remaining 30 odd is due to time, and that is not attributable to asset. That is because it is time. Hypothetically, if you constructed the asset and you dismantled it today only, you would not dismantle it at 50 rupees. Today, if you had to dismantle, probably there would be no inflation, etc. over the 10 years, and hence you will probably spend around 19 or 20 rupees only today. And hence, the true cost of the asset, which was increasing by 19.28, has already increased. The remaining is not attributable to the asset. Sir, then what is it attributable? Sir, it is attributable to time, and any cost which is attributable to time is like interest cost. Remember earlier you used to have interest cost, like if I were to take a loan today and I have to repay after 10 years, like a zero coupon bond of 19.28 today, which has to be repaid 50 after 10 years, then over the 10 years the cost is called as interest cost or finance cost. And hence institute gives you guidance where this unwinding of discount will be taken within finance cost. So this will be finance cost, which will go to the profit and loss account. This will not affect the cost of the asset. But what will be the finance cost? Well, while calculating 19.28, you have discounted at the rate 20, at the rate of 10%. Now, the opposite of discounting is compounding. If you wanted to go from a future value, that is 50, to a present value, you discounted it. Now you are already at 19.28, you want to go to 50. What will I do? Sir, I will compound. What is the rate of compounding? Sir, it is 10%. Are we understanding this? The concept over here is difficult. Once you practice a few sums, things will flow smoothly, but understanding the concept is a little tricky over here. So this is, let's say, 1.928 or 1.93. And your closing provision will be 19.28 plus 1.93 comes to around 21.21. That will become the opening plus 10%. Let's say this is 2.12. Approximately this will be 23.33. This is 2.33. Approximately this is 25.66. What do you guys think? Every year, if I'm keeping on doing this, where am I ultimately headed? This is, let's say, 28.23. Where am I ultimately headed? Can you give me the final answer that I should see after 10 years? 2.82. This will be 31.05. For example, this is 3.11 comes to approximately 34.16 plus 10%, 3.42. 37.57 plus 10% for 3.76 will come to around 41.33. 4.13 will come to 45.46. And hence, if I go to see ultimately, this comes to around 50. This is 4.55 or 54, let us say. That is right. So what will happen is your provision will ultimately come to 50 rupees in each of the years for this finance cost. Acha, if I total up all of these, this is my finance cost over the 10 years. This is 1.93, 2.12, 2.33, 2.57. What is the total ideally? 3.11. 3.42, 3.76, 4.13, 4.54. This is around 30.72. Can I say this is nothing but the difference between 50 and 19.28? For each of these, your entry will be finance cost account debit, which will go to the P&L, to the provision for site restoration. Sir, how will I call this finance cost? Like in finance cost, you might have interest cost, amortization of discount. This will be called as unwinding of discount. This will be called as unwinding of discount. And slowly, your provision will reach up to 50. And ultimately, when you actually spend that 50, you will not take anything else to the PNL. So this will be provision account debit to bank, which is 50. Sir, but it has to go to the PNL. It must have gone to the PNL. Sir, how much must it have gone to the PNL? Well, 30.72 must have gone to the PNL in the form of finance cost. And further, asset got depreciated at 109.28 instead of 90. So that 19.28, which was added into the asset, must have gone to the PNL in the form of depreciation. So what I've done is, rather than that 50 hitting the PNL after 10 years, that 50 will hit the PNL over the 10 years, either in the form of depreciation or in the finance cost. If some cost is due to the passage of time, I take it as finance cost. If some cost was due to the asset becoming more costly, it went into the asset cost. So the understanding over here is a little deep, but thoda, if you understand, you should be able to kind of grasp the concepts better when we do sums. Are we clear with this? Any problems, doubts, queries on this? Okay. So over here, when will I create this provision? Well, as per Ind AS, you will create a provision for site restoration when there is a legal or a constructive obligation. This is again an Ind AS 37 invention. It was not there in AS. There were two types of obligations. One, there is something called as a legal obligation, just a second. And second, there is something called as a constructive obligation. What do you mean by a legal obligation? A legal obligation is an obligation which either arises due to a law or it arises, let us say, due to a contract. Just a second. Yes. A legal obligation is an obligation which arises due to a law or a contract. Like, for example, keep aside the provision for site restoration. If I have to pay to my employees salary, if I don't pay them, can the employees sue me? Yes. Yes, the employees can sue me because contract, it is agreed as per contract and contract is enforceable as per law. Or an employee has served for more than 5 years, gratuity becomes eligible, I don't pay him gratuity. Can the employee sue me? Yes. Why? Because Payment of Gratuity Act is an act and hence there is a legal obligation. A legal obligation is an obligation which arises due to either a law or a contract. Like in our nuclear power plant case, there was a legal obligation, there was a contract where the government told me that I will give you this place of land to construct a nuclear power plant only if you agree. Only if you agree that you will dismantle this site once you are leaving it. So this is an obligation which is a legal obligation. Okay. On the other hand, let us say your employees are given Diwali bonus. So over here, let us say you have house help in your house and sometimes most of the employers usually give half a month or 1 month salary as Diwali bonus. Now that is not agreed in the contract, which means if you don't give that, they can't sue you. However, past practices, you have always given that for the last 20 years. Or published policies, there are policies where you generally give this Diwali bonus. This gives rise to expectation in the minds of the affected party and hence such obligations are called as constructive obligations. Constructive obligations are not legally enforceable. However, past practices or published policies give rise to expectation in the minds of the affected parties whereby we believe we will honor that obligation even if it is not legally required. These are called as constructive obligations. Ind AS focuses on substance over legal form. So they say whether the obligation is legal or constructive, we will treat it the same because if you have to incur it, then you might as well create a provision for it. So, but it is not legally enforceable. But you are going to pay Diwali bonus. If Diwali has happened, might as well create a provision for Diwali bonus. In a similar way, in the context, we'll study that at length in Ind AS 37, but in the context of site restoration, the government has not put any site restoration obligation on you. However, you have been a company which has always been operating in environmentally friendly way and your past practices or your general internal policies. Remember, policies are not enforceable because it is for a contract to be enforceable, there has to be two parties. So, your internal documents say that ideally you should dismantle or your past practices you have always dismantled even if there is no site restoration obligation because you are believing in operating in a very environmentally conscious way. In this case, under Ind AS 37, will we still create a provision for site restoration? Think and tell me, yes or no. Will we create a provision for site restoration? The answer is yes. Why? Because Ind AS requires you to create a provision for both legal as well as constructive obligations. And hence a provision for site restoration will be created. So over here, when we look at obligations, just you can focus on your screen. This is Ind AS 37. This is not just for provision for site restoration, it is there for every provision, whether it is Diwali bonus, warranty provision, site restoration provision, anything. Ind AS says an obligation, a provision will be created if there is an obligation and the obligation can be legal, like it can arise out of a law or a contract. So that is a legal obligation like salary or gratuity. or it can be a constructive obligation which can arise due to past practices. Like in the past, I've always given Diwali bonus. We look at our employers, we have done our articleship, we get a box of dry fruits, maybe if we are lucky. So, unfortunately, we don't expect anything from our employers. But let us say if there are employers who are giving, then there is a constructive obligation. Past practices or published policies which give rise to expectation in the minds of the affected parties. As articles, we don't have any expectation. हमको छुट्टी दे दे एग्जाम के लिए, that is more than enough. However, if your organizations have been giving you Diwali bonus, then in the current year also the employees would expect a Diwali bonus, and if the entity intends to give the Diwali bonus, then you should create a provision. A question can always arise that people can use this for manipulating. Well, in a way, yes, but that too you can use even useful life of an asset for depreciation for manipulating. We have to do accounting based on good faith accounting, and hence we will do accounting based on good faith, where if an entity intends to pay Diwali bonus, Diwali has gone by, currently they have not paid it, but they intend to pay it, in the past they have always paid it, then you should create a provision even if there is no legal obligation. Are we clear with this? And this logic does not just apply to Diwali bonus or a warranty provision, it applies to every provision. Are we clear with this? Yes? Okay. So, if I go to this site restoration obligation and mark it as very important from an exam perspective, just a second. Okay. So, from everything that you have studied today, this is the most important section because it has multiple indices which can be applied over here. Provision for decommissioning or site restoration, or it can also be called as dismantling. We have taken a fairly similar example, it is not exactly the same, but a similar example. So, these are legal or constructive obligations to restore the site back to its original condition at the end of the project. Legal as well as constructive, both. As per Index 16, the present value of these should be capitalized. So, here this is 90 and 40, we had taken 50 and the discount factor is 10%. Initially at year 0, PP account debit to bank, 90 you have spent and 40 ka present value you took. So, your total cost will be 90 plus 15.4 over here in this example, which came to 105.4, and depreciation in each year will be 10.54, thereby your asset will come down to a zero balance. Every year, the important part over here would be, there will be finance cost. This is unwinding of discount. 1.54 in the first year, this is nothing but 10% of 15.4 to provision for site restoration. We have explained 1.54 is attributable to the passage of time and hence should be recorded as finance cost. It should not be taken to the asset. It is linked to the passage of time and hence it will be taken as finance cost. Are we clear with this? So, we have done this for the entire 10 years so that you get a bit of clarity. Okay. So, this kind of looks at the basic discussion. There can be a possibility of a change in the provision for site restoration as well, but we will keep that separate. For the time being, we will try to do a few problems and I would want you to probably practice one problem for a deeper understanding of site restoration provision before tomorrow's class. Okay. You have to try that on your own on pen and paper. And we will take that forward in tomorrow's class. Okay. So, first you have question number 1. Easy question. If you see a QR code next to it, it will be an important one. If there is no QR code, usually it is not as important. So, we will just review it quickly. On 1st April 2011, X acquired a machine under the following terms. Okay. List price of the machine. What do you guys think? Should this be a part of the cost? Yes. Import duty. Should this also be a part of cost? Yes. Delivery fees. Well, it is to get the asset in the location and condition desired. Should this be a part of cost? Well, yes. Electrical installation cost. We will assume we will write DE over here. D is or DA. DA is directly DAE, directly attributable expense. This is a very basic question, so we can get this clear. Okay, and pre-production testing. Think and tell me, will this also be a part of your cost? Yes, it is pre-production and hence it is directly attributable to get your asset in the ready to use condition. However, it was given that this is a testing cost after the asset is ready for use. Will that be a part of the cost of the asset? No. Like you do quality control checks. Will that be a part of the cost of the asset? No. It is subsequent expenditure after the asset is ready for use. Okay. Now purchase of a 5-year maintenance contract with the vendor, 7 lakh rupees. Think and tell me, this is maintenance cost. You are paying the money upfront, but merely because you pay it upfront, does that mean it is a part of your cost? What do you guys think? Will maintenance expense? No. Maintenance expense is subsequent expenditure to be incurred after the asset is ready for use, and hence this will not be taken as a part of your cost of your asset. Okay. In addition to the above information, XYZ was granted a trade discount of 10% on the initial list price of the asset. Think and tell me, what do you guys think on the initial list price of the asset? There's a 10% discount. Will that be added, deducted or ignored? Deduct. So 8 lakhs minus 10%, this is let's say 80 lakhs minus 10%, this is 8 lakhs and hence 72 lakhs. And a settlement discount of 5% if payment of the machine was received within 1 month of the purchase. Okay, there are two types of discount. One is a trade discount and one is a settlement discount of 5%. So you can highlight these two things. There's nothing much over here, to be honest, but if you had to refer, you'll see what is to be done with maintenance and you'll see what is to be done with settlement discount. Now this settlement discount is not really called as a trade discount or a cash discount, but this is a discount linked to early payment. So what do you guys think? Is it in the nature of cash discount or is it in the nature of trade discount? Cash discount, because it is linked to early payment and hence it will be taken to the P&L account. XYZ paid for the plant on 20th April. So over here, these are the two things that you will highlight. So only these things you will review. XYZ paid for the plant on 20th April. At what cost will the asset be recognized? So if I want to find the cost of the asset, I will say 80 lakhs minus 8 lakhs plus 5 lakhs plus 1 lakh plus 10 lakhs plus 4 lakhs. I will not deduct the cash discount. I will write a note for the same and I will not add the maintenance expense because it is subsequent expense and I will write the note for the same. So over here this is 72 and 5 and 6 and this comes to probably 92 lakhs. So initial recognition of your asset will be at 92 lakhs. So the corresponding impact in the solution also you will highlight. Maintenance expenditure is subsequent expenditure, should not be capitalized, and settlement discount is the nature of cash discount and should be taken to the P&L. These are your exam notes. Remember, if something is not taken, you will write a note in the exam. In your books, you will find something like reference notes. Reference notes is for your education and your reference. You don't have to teach the examiner. In your main exams, you don't have to write the reference notes. You can write these notes in your own words. You don't have to reproduce what we are saying. Generally, if a particular item is taken in the calculation, you don't have to explain anything, but if it is not taken, you'll have to explain in a note why you have not taken it. So you'll explain that cash discount is taken to P&L and hence not subtracted. Maintenance expenditure is subsequent expenditure and hence not taken. This is a reference note. Testing cost, if it is pre-production, you would capitalize like over here. If it is post-production like quality control, you will expense it like over here. Question 2 is also a very basic question. We will try this. The term of a lease allows a tenant, that is XYZ, to tailor the property to meet its specific needs. So you can customize the property to meet its specific needs by building an additional internal wall, but on the condition that the tenant returns the property at the end of the lease in its original state. Again, you have taken a property, I have taken a big property, but I want to make small classrooms inside. So I can construct internal walls. These are called as leasehold improvements. So that wall is tangible in nature, it is held for use and is having a life of more than 12 months. Achha, does that internal wall that I construct meet the 3 PPE criteria? It is tangible, it is held for use and it has a life of more than 12 months and hence the construction cost of the wall, let's say 100 rupees, will be sold as leasehold improvements. Or yes or no? Okay, so you have been told that you can tailor the property to meet the specific requirements, that is building an internal wall. So the construction cost of the wall will definitely be at the part of the cost, but on the condition that the tenant returns the property at the end in the original state. So is there a site restoration obligation as well? Yes, this will entail dismantling. You don't have to highlight this per se. I am just showing this. Whatever needs to be highlighted, I will tell you. This will entail dismantling the internal wall. XYZ incurs a cost of 25 lakhs on building the wall. What do you guys think? Will this 25 lakhs construction cost, will it be a part of the cost of the asset? Well, yes. And the present value of estimated cost to dismantle the wall is 10 lakhs. This is already given in present value terms. So you don't have to do any discounting. But what do you guys think? Will this 10 lakhs also be added to the cost? Yes. Because there is a legal obligation to dismantle. At what value should the leasehold improvements be capitalized in the books of XYZ? Sir, they will be capitalized at 35 lakhs. Your journal entry, if you had to pass, would have been leasehold improvements account debit 35 lakhs, to bank 25 lakhs, to provision for site restoration 10 lakhs. So this will be shown at 35 lakhs. Achha, now before tomorrow's class, I would want you to read, and if possible, if you have the confidence, because यहाँ पे थोड़ा problem आ सकता है, if possible, try. It is okay if you make a mistake over here. This is an important question. It is an LDR question. ये आप try कर पाए तो best है, but otherwise at least read it so you have clarity before tomorrow's class. So this will be an LDR question which we will try tomorrow. Question number 3. This you will read before tomorrow's class, and for a better understanding, you will go to question 22. I think over here you will try this. Okay, first part of this. Let me just read this once. Question 22. This you have to try. This is only the part A. Part B we have not yet done. Only the part A. If you try this, remember we are doing an exam oriented batch, so I will solve every sum, but I can't keep and wait and for you to keep on solving each and everything in class, because if we do that, again it is going to take the time as much as a regular batch. So I will guide you on things which you can practice, and you should diligently do that before the next class, so that you get that perspective before you come for class at your own speed. Okay, so I'll read question 22, part A. You will try. H purchased an item of PP costing 100 million, which has a useful life of 10 years. Okay, the entity has a contractual decommissioning and site restoration obligation estimated at rupees 5 million to be incurred at the end of 10th year. You guys think and tell me, फटाफट बोलेंगे, is this 5 million present value or is it future value? FV, PV? FV. So will we have to do discounting? Yes. वो आप खुद से try करोगे. You will try discounting. The current market discount rate is 8%. You will take 4 decimals, round off the 4th decimal if it is 5 and above. The company follows SLM method of depreciation, and H follows the cost model for accounting PP. Fair enough. So if depreciation is to be there, it is going to be done using SLM. Determine the carrying item of an item of PP. So this is the WDV of the PP, and decommissioning liability. This is the provision balance. At each year, it's more like a concept builder when there is no change in the expected decommissioning expense, timing of incurring those expense, and the discount rate. You will just try this. Point B we will do in class tomorrow. So sir, what are they asking me? Sir, they are asking me to find something like this. At each year end, what will be the value of the provision? Apart from that, they are also asking me to find the PP carrying value. Like over here, this would have been 109.28 minus 10.928. Then वापस second year minus 10.928. Are we understanding it? There is nothing new over here, but you will get a very good understanding if you kind of do this over the life. You will do the present valuation on your own. Don't refer the solution. Find the carrying value, find the provision balance. Then in part B, we will see if there is a change in estimate. How will we take it forward? Will you be able to try this? Promise कर सकते हैं अपने को? Yes, ensure that you try this, and if further time permits, you can read question 3. We will solve question 3 in class from scratch, so that you have a better understanding before you come for tomorrow's class. ठीक है? Anything else over here? We can discuss. Otherwise, we can stop for the day. And thank you very much for your time and patience. I will see you tomorrow, same time, 7 AM sharp, and we will continue with Index 16. Okay?